Most locked in at 2%, they're renewing at 4 or higher. Here's who gets hurt the most. The math is brutal. A homeowner who locked in at 1.9% on an $800,000 mortgage was paying roughly $3,300 a month. At 4.2%, that resets to roughly $4,400, $1,100 more per month, $13,200 more per year. Money that simply didn't exist in the budget. Most of these mortgages were taken out in 2021 and 2022 when rates were at historic lows and prices were at historic highs. Buyers were told rates would stay low. Many chose variable rate mortgages or short 3-year terms, thinking they could renew at similar rates. That gamble did not pay off. 80% of economists predict no rate cuts for the rest of 2026. Some warn rates could increase if inflation picks up from Middle East tensions and new tariffs. The people getting hit hardest fall into 3 groups. Group 1, pandemic buyers who stretched. Between 2020 and 2022, prices surged 30 to 50% across nearly every Canadian market. Buyers competed in bidding wars. Many waived conditions, skipped inspections, and paid well above asking. Those buyers now approach renewal. Many purchased at peak prices with minimum down payments. Since then, prices in Ontario dropped 5 to 8%, in Brampton 30%, in Hamilton over 8%. These homeowners owe more than their home is worth. Negative equity. That means they cannot refinance because there's no equity to refinance against. Their only option is to renew with their existing lender at whatever rate is offered. Zero negotiating power. Group 2. Condo investors bleeding cash. In Toronto, roughly 3 out of 4 pre-construction units during the pandemic were bought by investors. Many of those units have now closed at 2021 prices into a market that's fallen 9%. Carrying costs, including mortgage, condo fees and property tax, often exceed rental income by $500 to $1,000 a month. When the mortgage renews higher, that gap gets wider. They can't cover costs from rent, can't sell without a loss, can't refinance because the unit is worth less than owed. Nearly 4,000 completed condo units sit unsold in Toronto. That number is growing. Group 3. Multigenerational households. Brampton has the highest rate of multigenerational households at 14.3% compared to the national average of 2.9%. Multiple families contributing to one mortgage. During the pandemic, this worked. Multiple incomes covering one massive payment. Basement rentals to students bringing $800 to $1,000 per room. Then student numbers dropped. Rental income disappeared. If one earner in the household loses a job, the entire household's ability to pay is affected. $13,000 more per year on a payment that was already stretched across multiple family members is often the breaking point. And here's why the #1 risk factor in this crisis might surprise you. It's not the borrowers, it's the geography. Equifax flagged 5 cities as primary drivers of Canada's delinquency surge: Brampton, Toronto, Markham, Oshawa, and Vancouver. Large mortgage balances, steep price declines from peak, high concentration of investor properties, maximum exposure to the renewal wave. Near-prime borrowers in these 5 cities have delinquency rates of 0.64%, nearly 3 times the national average. These aren't subprime borrowers with bad credit. These are people with good jobs and good scores who simply bought too much house at the wrong time. OSFI, the federal banking regulator, described the concentration of renewal risk as a potential systemic vulnerability. Regulators don't use the word systemic casually. The Bank of Canada flagged mortgage renewals as the single biggest vulnerability in the housing market heading into 2027. Here's what makes this different from 2008 in the United States. Canadian mortgages are recourse loans. If you walk away, the bank comes after your other assets, your savings, your wages. That means fewer strategic defaults but more prolonged financial suffering. People don't lose their homes as quickly. They slowly drown under payments they can't afford, while equity disappears. The renewal wave isn't a cliff. It's a slow squeeze playing out over 18 to 24 months. Every month another batch resets. Another group absorbs the shock. The cities where prices ran highest and fell hardest feel it first. If your renewal is coming, talk to a mortgage professional now, not after you miss a payment. Options include extending amortization, switching lenders, locking in a fixed rate, and negotiating with your current lender. All of these work better the earlier you start. What rate are you renewing into? Drop it in the comments.